Okay, so this is chapter 4, the accounting cycle. We'll be going over the full cycle of how accounting and bookkeeping is done in a business. And so this sort of uses everything we've done in the past 3 chapters. And then now we incorporate the month-end close, and then we have all of the nuts and bolts for how is accounting done for a full cycle for a business. And so we're going to show the flow of accounting information from the unadjusted trial balance to the adjusted trial balance and the financial statements, similar to how we did in chapter 3. Prepare the financial statements from adjusted account balances, journalize closing entries, which close out all of our temporary accounts for period in time accounting items so that they're ready for next month. And then, taking a look at the accounting cycle as a whole for a single period. Then we're going to take a look at cash basis versus accrual basis accounting and why accrual basis is used, and describe working capital and current ratio. And then we're going to take a look at the end of period spreadsheets that can be helpful in the accounting cycle process, as well as preparing the statement of cash flows using the direct method. So accounting, it's an information system. It gets all of the transactional data that we take a look at throughout the period, and it consolidates it into reports so that business, managers, business owners, banks, everybody knows how much money this business made, how much they spent, where they spent it, and how much money they have. And really what that tells about, is this a viable business for the future? And so as part of this, we have a number of adjusting entries. We have our day-to-day transactions throughout the period. Then we have our adjusting entries at the end of the period that we went through in chapter 3. And then all the information flows from our trial balance to the various financial statements. And so then that's where all that information comes from. And using the adjusted trial balance, we can prepare the income statement, the statement of owner's equity, and the balance sheet. And then the statement of cash flows, we can prepare by taking a look at the transactions that are in the cash account and applying them to the different cash flow activities, operating, investing, and financing activities. And so if we take a look at the adjusted trial balance, all of the balances on the income statement come directly from the adjusted trial balance. And then we get our net income from our income statement. And then investment by owner is usually described somewhere, like we can know the investment by the owner based on the journal entries that have happened throughout the period, or it will say the owner invested $10,000 in the business. Then the withdrawals, that would be the drawing account on the trial balance. And then we have our ending capital balance, and that goes from the ending capital on the statement of owner's equity to the capital balance on the balance sheet. And then we also take all of the balances for balance sheet accounts directly from there, from the trial balance, that is. And the income statement is prepared directly from the adjusted trial balance, beginning with fees earned. And the income statement accounts are listed order of size, beginning with the larger items, and miscellaneous expense is the last item, regardless of the account, or regardless of the amount. So you can think of it as everything is listed from least to greatest, and then miscellaneous is everything that was too small to be listed separately is listed as miscellaneous or other expense, and that's at the bottom. And there are some examples that we're going to go through on the slides that don't obey this order. But this is the best practice, is ordering the expenses from least to greatest. From greatest to least, I mean. So larger expenses at the top, larger revenues at the top, if the certain, types of revenue streams are more than others. And the statement of owner's equity, we prepare that. We have the beginning owner's equity balance, then investment by owner, net income or loss, and then withdrawals, and then the ending balance. So it really just shows everything that's happened in the capital account throughout the period. And our and this this whole process here on how equity changes is the basis for all the closing entries that we'll be doing um, later in the slides, because a lot of these only the additional investment by the owner, that's the only credits that are hitting Chris Clark Capital account during the period, during like the everyday operations of the business. Like Chris Clark deposits $25,000 into the business, then that would be debit cash, credit Chris Clark Capital. But throughout the period, right, there's all these revenues, there's all these expenses. That's impacting the capital balance, but we're not actually crediting Chris Clark Capital for the revenues or debiting Chris Clark Capital for the expenses until the end of the period when we do these closing entries. Even though that stuff impacts owner's equity because net income increases owner's equity, net loss or expenses decrease owner's equity. Same with withdrawals, decrease owner's equity, but we record it separately in a drawing account. The closing entries at the end of the period summarize all of that and move it into the capital balance so that it's the beginning capital balance at the beginning of the next period is accurate on the post-closing trial balance. So that's a big summary of what we're going to go into in this chapter. And then the balance sheet is prepared directly from the trial balance with and it starts with cash. So all the assets are listed in order of liquidity, which is how soon can they be converted into cash. That's why cash is at the top. Next is generally accounts receivable, because that's going to be collected within 30 days and turned into cash. Then in this example here, then we have supplies and prepaid insurance. Those are both prepaid expenses, and those are prepaids are going to be used up within 1 year. Current assets are listed in their own section. This is what's called a classified balance sheet, which means that we have current assets. We list all of our current assets, and then we have a subtotal for total current assets. And then we list our property, plant, and equipment. And we have a subtotal for the book value of the office equipment, which is office equipment less its accumulated depreciation. And then we also have a balance for total property and equipment. And then total assets is another sort of subtotal there. And then the liquidity, the liability accounts are listed in the order in which they are due. So the liability accounts, such as accounts payable, are generally due first. They're due within 30 days. Sometimes it can be due within 90 days. But those will be listed first, and then long-term debts will be listed further down. And generally, this is the same order as the items appear on the trial balance, which makes it a lot easier to determine when doing a homework for the balance sheet. Really, it's really easy that all the amounts, they're in the same order on the trial balance as they'll appear on the financial statements. So that can be really helpful. Which is also the same order as they would appear in the chart of accounts, right? If you remember the chart of accounts, like cash is usually first as like number 11, and then accounts receivable is number 12, and then it goes down like that. That numbering system is sort of made with that in mind. And so current assets are cash or other assets that are expected to be used. Current assets are going to be sold, used up, or converted to cash in the normal operations of the business within a year. For example, notes receivable and amounts customers owe the business. Accounts receivable are due within 30 days. They're generally um, don't need a written agreement, but it sort of helps. But an accounts receivable could be created just by sending a client an invoice for goods that they were provided for, and then they now owe the business money, right? But a notes receivable would be a much more formal agreement where it's like, okay, we're going to sell you this washer dryer, and there's a 6 to 12 month payment plan. That would be more of a notes receivable than a accounts receivable. Notes receivable are like a little bit more long term, but generally are still due within a year or less, and then they can be due longer though. But generally, so notes receivable and accounts receivable are amounts customers owe the business. And then property, plant, and equipment may also be described as fixed assets or plant assets. That's uh, equipment, machinery, buildings, and land. Um, they depreciate over time with the exception of land. Land does not depreciate. And so if there's a building on land, then the values are separated, right? And they're listed out separately so that the building can be depreciated, but the land remains the same value. And then that creates the um, accumulated depreciation account, which is a contra asset account. It reduces the book value of our office equipment, but we want to keep our office equipment at historical cost on the balance sheet. And then we reduce it by accumulated depreciation to get the net book value of the equipment. And that's how it's reported. So accumulated depreciation is an asset account, but it is also has a natural credit balance. Then liabilities. So current liabilities are all due within a year, and long-term liabilities are not due until more than a year from now. And so this is important to know as and disclose on the financial statements, because if the debt is due currently, right, that's a much more pressing concern than if it's due in a more long-term manner. Um, and then the owner's right to assets of the business, that's what's left over for the owners. That's in the owner's equity portion. So the capital balances. Um, you could also see, we'll go over items later in this course about retained earnings, um, common stock balances, additional paid-in capital balances. But right now, we are just going to that uh, take a look. Like, the only account in it right now is Chris Clark Capital. Like that's what's on there, and the capital balance is on there relevant to really small businesses like sole proprietorships or partnerships. If you get into bigger businesses that have stock and additional paid-in capital and things like that, then we get into those items. We have a special chapter on equity towards the end of the semester. Then the statement of cash flows shows all the activity that happens with cash transactions during the period. And it can be prepared using two methods. There's the direct method, which is what we'd be doing this chapter, and that is taking a look at every transaction in the cash account and classifying it towards which type of activity is this? Is this an operating activity, an investing activity, or a financing activity? Operating activities are normal business operations like collecting money from customers, paying out cash for expenses. Investing activities are purchasing long-term assets such as investments, property, plant, and equipment, or selling long-term investments or property, plant, and equipment. Financing activities are activities with owners, or lenders. So getting new investment from owners or taking out a loan would be a financing activity. Paying back the loan and paying back investors, that's a financing activity. And this is really insightful into how a business is getting its cash and how it's using its cash, and it can really help build a narrative of like, what is this business doing? Are they investing for the future, or are they an established market player and like just sort of collecting um, all the money from the brand that they've already built up? Do they have huge capital requirements? For example, like a cruise ship company has to buy new ships all the time. And that would be a giant investing cash flow, purchasing new ships all the time. What are the capital requirements for this business to continue operating successfully in the future? So, in practice, the statement of cash flows is prepared using a more complex method called the indirect method. And we'll go over this in the last chapter of this course. Basically, uh, the indirect method calculates operating cash flows by showing net income and then reversing all of the accrual non-cash items from net income. Non-cash items like depreciation is a non-cash expense. Changes in accounts receivable impacts cash. Changes in accounts payable. That is all things that are done using the indirect method. And that means that we don't have, using the indirect method means that we don't have to look at every single transaction, which is super important for businesses that have a lot of transactions. And um, that's like the majority of businesses more than like some really small businesses would be able to use the direct method. But anything bigger than that, um, it would be just faster to use the indirect method because then you don't have to look at all of the individual transactions. So we'll go into that in chapter 13. So which of the following would not be considered a current asset? Yep, land, exactly. Land it's a long-term asset, part of property, plant, and equipment, and it's not depreciated either. And current assets are used up in a year or less. And so we're going to skip these couple examples here. It's classifying accounts into the financial statements that they go. But again, this first couple slides here is just review for you guys. You guys are all pros at this. You've been um, create doing the journal entries, creating the financial statements on the homework and the quizzes and the exams. But it's important that we go over these because um, we'll be getting into an example now. So this is the end of period spreadsheet. And so what this does is it's useful for preparing the adjusting entries because we have the unadjusted trial balance, the adjustments that are made, and we have debits and credits. We have all the different accounts, and then the adjusted trial balance. And what this allows us to confirm is that the unadjusted trial balance balanced, all the adjustments balance the debits and credits, and then the adjusted trial balance also balances. And it allows us to, if we have formulas that automatically adjust for the adjusting entries, right? So we have the beginning, the adjustments, and then this is formula generated. We can compute this sort of as we go, and it's live updated, and it just makes it really easy to calculate these adjustments and then use the adjusted trial balance to create the financial statements after that. So we have this example, and they also give us during the year, Mary invested an additional $15,000 in the business. So that's important to know because we see this Mary Paoli capital, it's 1,960,000. So for preparing the statement of owner's equity, we need to know what the beginning balance was. And so to get that beginning balance, we need to just use a little bit of algebra. So right in statement of owner's equity, we've gone through this a few times before. Beginning capital, additional investment, net income or loss, withdrawals, ending capital. So to get beginning capital, we have to first start with the additional investment by the owner. Then we see that at the end of the period, we had 1,960,000. And I'm sorry for the sort of grainy projector here, but we have 1,960,000. And then that means our beginning balance was 1,945,000 because we just have to take that $15,000 out and then we find our beginning balance. Then to get our net income, so I skipped the slide here. The income statement is done first. So we take our fees earned and all of our expenses just directly from the income statement, from the adjusted trial balance here. So it's all at the bottom portion. And uh, we use the order in which they appear on the trial balance. Um, Notice that they did not order the expenses in order from greatest to least, to which I say, shame on them. But um, that's fine for this example. We basically just transfer it right from the trial balance to the income statement. We get our net income, and that goes straight to the statement of owner's equity. And then our withdrawals come straight from our withdrawals account, Mary Paoli drawing account, a debit of $30,000. And then we have our ending capital balance of 2,595,000. Then we take our balance sheet items. Those come straight from the adjusted trial balance as well. And they're already in order that they need to be in, the order of liquidity. So we have cash, accounts receivable, supplies as our current assets. Then we have a subtotal for current assets because it's a classified balance sheet. And then we have our land balance and then building, less accumulated depreciation and the net book value of our building. And we take that right from building and accumulated depreciation accounts. And then we have our total property, plant, and equipment subtotal, total assets. And then for the liability section, it's also listed out right there. And we get our capital balance from the statement of owner's equity. And um, here's, another example. So, and in this example, Jason invested an additional $5,000 in the business. So we prepare the financials just by taking all the expenses from their proper section. And then we had the additional investment of 5,000 and the ending balance of the capital account on the adjusted trial balance was 72,200. So we take 72,200 minus 5,000 is 67,200. And um, we can do that because during the day-to-day journal entries, the only transaction that's affecting the Jason Neese capital account is additional investment by the owner. Even though there's other transactions affecting the equity portion of the accounting equation, they aren't actually hitting that ledger account. So we know we know that this additional investment by owner is the only activity in that account during the period. So we can back that out and we can get the beginning balance. Then we have our net income from the income statement and our withdrawals from the drawing account. And then the ending balance, prepare the balance sheet in the same manner as the previous problem. And then for this example, we're told to prepare the statement of owner's equity. And what we see here is we have the capital account, we have a beginning balance of 4,225,800. We have an additional investment of 25,000. Then we have a um, we have $700,000 credit to capital on December 31st, and we have on December 31st $160,000 credit debit to capital. And then notice how this $160,000 debit right here is the same as this $160,000 debit right here in the drawing account. And then we have these $40,000 quarterly dividends that's being paid out to the owner. This $40,000 debits, drawing dividends end up being debits to the drawing account. And so this is the quarterly dividend payments. And then at the end of the period, this is the first we're seeing of the closing entries that I was talking about earlier. So then it's credited, that reduces the drawing account to zero. It's a temporary account, and it goes over here. And this will make just a bit more sense when we go over the amounts, but I just wanted to seed this information because what these balances impacting capital are for is the net income for the period, and the withdrawals impacts the capital balance at the end of the period. So those December 31st entries, these are the closing entries that we'll be preparing. But we can prepare just from these two accounts here, we can prepare the statement of owner's equity because we have the beginning balance, the investment, the withdrawal, the income and the withdrawals, and then the ending balance is the ending balance of this T account in the post-closing trial balance. So we'll prepare that as well later. Additional thing to note is that on the balance sheet, when we separate liabilities into current and long-term liabilities, we sometimes have to separate liabilities that are partially due within the current year. For example, a mortgage that's a $375,000 mortgage, the payment is $1,250. You can tell that this was made in a period of low interest rates, this slide. The payments due within the current year are a current liability, and then the portion that's due later than 1 year from now, that's a long-term liability. And so the liabilities that are due within 1 year are $15,000, $1,250 times 12 months. That's a current liability on the balance sheet. The remaining portion, which is $360,000, would be a long-term liability. And it's important, so it's important to separate them, but it's also a really common mistake that I see is finding out the amount that's due within the current year, which is $15,000. Listing 15,000 as a current liability, and then listing 375 as a long-term liability. And then what that does is it puts the accounting equation out of balance because liabilities have got the total liability from this mortgage is 375. So we need to make sure that only 360 is put in the long-term section so that the total mortgage disclosed on the balance sheet is equal to the total mortgage of 375. Also, I think it's important to note that this is a bit of an oversimplification because only the principal payments would be disclosed as a current liability because right there, when there's a mortgage, there's current, there's the interest portion of the payment and the principal portion of the payment, or really with any loan. And so only the principal payments are considered short-term current liabilities because the interest portion has not been an expense yet. So when, right, as we have interest expense throughout the period, we'd have to have a journal entry, debit interest expense, credit, either cash or interest payable. And so that interest expense is not a liability yet because under accrual accounting, we have to match the expenses to the period in which they're incurred. The following year hasn't passed yet, right? So the interest portion has not been accrued yet. So technically, the interest portion is not even on the balance sheet yet. So if this payment was $1,250 in principal payment and then another $250 or $400 in interest or something per month, that interest portion would not show up on the current portion. So I just wanted to put that out there. But we'll talk a lot more about debt and loans and notes payable and things like that. We have a special chapter on liabilities, so we'll go over that then, much more in depth. Excuse me. So we gotta move on a little bit. So closing entries um, are uh, to close out the accounts that show items over a period in time. So for example, when we have our income statement, it says for the year ended 2025, or for the year ended December 31st, 2025, or for the month ended January 31st, 2026. And so the income statement accounts track the activity. And at the beginning of the year, the activity has to be reset to zero, or at the end of the year, right, it has to be reset to zero. That's what these closing entries do, because those balances on the income statement accounts are not carried forward from year to year. But the balance sheet accounts are carried forward from year to year. The balance sheet's a snapshot in time. And so um, those are what's called permanent or real accounts. And then the income statement accounts and the drawing account, those are activity accounts. They're also called temporary accounts or nominal accounts. And they're not carried forward because they relate only to one period. When we want to have our revenue account or our expense account, we're not trying to record and have a running balance of all the revenue a business has ever generated ever. We're just trying to do this month of revenue or this quarter of revenue or this year in revenue. And at the beginning of the next period, all of the temporary accounts should have zero balances. And so to achieve this, the balances are transferred to the permanent accounts at the end of the accounting period. That's a portion of that is the journal entry we looked at with the T accounts, with the capital and the drawing accounts, where everything gets closed. All of these um, temporary accounts get rolled up into the capital account. If you remember that graphic with the accounting equation where we had assets equals liabilities plus owner's equity, and under owner's equity, we had our revenues, our expenses, and our drawing accounts. Those are all the activity accounts that we're recording throughout the period, and those all roll up into equity at some point, and this is the process of how we actually do that. And so the journal entry is called a closing entry. And the process is called the closing process, sometimes referred to as closing the books or the month-end close. And so the closing process involves two, two journal entries. One journal entry to close out all the revenues and all the expenses to the owner's capital account. And so the owner's capital account gets debited or credited based on the amount of net income or loss of the period, because that's the difference between the revenues and the expenses. We're zeroing out all the revenues and expenses, and then the difference in debits and credits to balance our journal entry is going to equal net income. And then the drawing account is also transferred to the capital account. So we just have to zero out the drawing account. It's going to be a debit balance, so we need to credit it. We need to credit the drawing account, debit capital, so it's reducing capital that's been paid out to the owners. And so we um, debit each revenue balance because revenues have a credit balance. And then we credit all of our expenses. And then we balance the journal entry based on the net income or loss. Then we debit the owner's capital account for the balance of the owner's drawing account, and then credit the drawing account for the balance. Um, and they're recorded and dated as of the last date of the period. So when we saw that example with the preparing the statement of equity from the T accounts, those closing entries were dated as of the 31st. It's the same as when we do adjusting entries, they're dated as of the 31st. And that's even if this is done as like on the 10th of the month or the 15th of the month to close out the books for the beginning of the period. There's a big process that the accounting teams at large companies do to do this, right? This isn't done in real time. And even at a small business, if you know, if we have if any of us have just a small business and we're doing QuickBooks or something, we're not doing this on December 31st. Like, right, there's a small delay there that to when we do this bookkeeping. So this is how it looks in the T accounts. So, right, we have our expense accounts, they have a running debit balance. The revenue accounts have a running credit balance. The temporary accounts have a running, the drawing account has a running debit balance. And so we um, essentially we just have a journal entry that reduces all of the running balances for these ledger accounts to zero. And so we debit revenue for the whole amount, debit each one of the expenses for the whole amount, and then that net income ends up being a credit to owner's capital if it's a net income, or if it's a loss, it ends up being a debit. And then the drawings are a debit on the owner's capital account side. And we have generally, this is like at a high level, but on a more detailed level, we have a bunch of different expense accounts and a bunch of different revenue accounts. And um, we have to zero out every single one of our revenue and expense accounts. And then, so then that what that ends up doing is creating a huge journal entry where we're debiting all of our revenue accounts and crediting all of our expense accounts to reduce the net balance at the end of the period to zero so that it's ready for the next period. And then what this also does is then we credit Chris Clark Capital for the amount of net income that they had during the period, and then debit it for the amount of drawings that happened. And so then it impacts our general ledger here. So the balance sheet accounts, such as cash, accounts receivable, supplies, there's no impact. There's no closing entry here because they are truly a running balance. They're at a period in time, they're permanent accounts. But as soon as we get to the capital accounts, um, the they are impacted, as well as the income statement accounts. And so the drawing account is a temporary account, so that gets zeroed out. And then Chris Clark Capital, that ending balance ends up being the same balance as will appear on the balance sheet and on the statement of owner's equity, because we have beginning balance, zero, investment by the owner, net income, withdrawals, ending balance. It's exactly the same as on the statement of owner's equity. Um, and then the rest of these get closed out to zero. So then they have a zero balance. So they're ready to start the next period. And then we have a post-closing trial balance. And then this is all the amounts that will appear directly on the balance sheet. Um, and then this is just these will be the beginning balances for the next year or the next month or the next quarter. And it only has the balance sheet or the permanent accounts. So it does not have any of the income statement accounts, and it does not have the drawing account on the post-closing. So which of the following would be considered a nominal account rather than a real account? Anybody want to help me out here? Yep, exactly. Thank you. Yeah. So rent expense, it's an income statement account, so it'd be a nominal account, and not a real account or a balance sheet account or anything like that. So just to the accounts that are closed are all the expense depreciation expense, like that's going to be closed, fees earned, drawing, and then all of the supplies expenses, wages expense, and then the balance sheet accounts will remain. And so if we just have we know the balances of these accounts and we can assume that they're all in their natural state. So we like, even though we don't know the debits and credits, we know that fees earned is a revenue account that's a credit balance. So we can prepare the adjusting entry or the closing entry that's needed from there because we know that fees earned is a revenue. So we need to debit our revenues. We credit all of our expenses. And then we have a credit to the drawing account to reduce that to zero. And then we know that our net income then is 127,600. And that's because we just like we need the journal entry to balance. That 127,600, that's what plugs the journal entry. That's what makes it balance, and that's what the net income is for the year. So we can prepare a post-closing trial balance, and there's a number of issues here, mainly with just the um, whether whether the numbers are displayed as a debit or a credit. And uh, as we can see, the debits and credits do not balance in this. So supplies and equipment should be a debit, accumulated depreciation and accounts payable should be a credit. And then as should the unearned rent and salaries payable, those are liabilities. So they need to be a credit as well. And then our items balance. So the accounting cycle, uh, this is um, the culmination of everything we've done in the last few chapters is the accounting cycle. And it begins with journalizing and analyzing all the transactions, so the everyday um, operations of the business, and it ends with the post-closing trial balance. And so like, I'll be honest, there are a few large homework problems this week, and they go through every single step of the accounting cycle here. And so I have a video that goes over one entire problem, a full end-to-end walkthrough of it. Um, but yes, so I would make sure to get started on the homework. Uh, because yeah, so the transaction, so it goes through analyzing the initial journal entry transactions, post the transactions to the ledger, and then preparing the unadjusted trial balance, assembling the adjusting entry data, creating an end of period spreadsheet, creating the adjusting journal entries, an adjusted trial balance, creating the financial statements, uh, creating and posting the closing entries, and then a post-closing trial balance is prepared. And then with that, I mean, this is all of the nuts and bolts of accounting right here. Like you guys have all the skills to do all the journal entries for a period, the full accounting cycle for a business. All the future chapters that we're going to go through in this course are getting into the weeds on how to do particular transactions. How do we treat inventory? How do we treat property, plant, and equipment? How do we take a look at um, notes payable, equity section, more in depth on the statement of cash flow, cash and internal controls, which is like fraud prevention, basically. Um, that's what we'll get, and like bank reconciliations, like that's all what's future in the course. But with this, I think what's really cool about this is in the first four chapters of an accounting course, like now you guys are perfectly capable of doing the journal entries and the closing process for um for a business. You know how it works, right? And um I think that's really cool because what accounting is, right? It's taking all the transactions of a business and boiling it down so that we can create these reports and we can uh, show managers, stakeholders, decision makers how much money the business has, how much it made, where it's spending it. And that's really important for understanding how it all works. And then I think what's also really key too is when those decision makers have questions, we know exactly how to trace it back to all the transactions, right? Because we have all of the transactions during the period. Um, and so there's a history of everything that happened, and we can figure out why it all changed. Um, and so just some more pictures that go along with the process here. We have our accounting equation, assets equals liabilities plus owner's equity. And then um, the owner's equity account, like part of the accounting equation, is the income statement accounts, which is our revenue accounts with a credit balance, expense accounts with a debit balance, and drawing accounts with a debit balance. And they all go up into owner's equity. And so that's why when we're doing closing entries, we need to close it out into our capital account. And so then we prepare the unadjusted trial balance after we've um, posted all of our accounts. And then we make our adjusting entries and prepare an adjusted trial balance. And then in sometimes the end of period spreadsheet can be helpful in creating and tracking those adjusting entries. And that's why it's done before the adjusting entries and the adjusted trial balance. And then we prepare the financial statements and journalize our closing entries and then a post-closing trial balance so that we're ready for the next period. And so you can imagine, so that at a small business, right, it's generally either the business owner or like one bookkeeper that's doing all of this stuff for a small business, right? They have all the transactions, they have all the information. At a large business, this whole process is overseen by the controller. They're the head of accounting for a business. They oversee all of the month-end close process, all of the accounting activities that go on throughout the period, and then the closing process as well. And um, that's contrast that right to the CFO. The CFO, like they're the head of all the finance activities, and the controller would report to the CFO. Um, but the CFO doesn't actually get into the weeds on doing all the accounting, journal entries, overseeing all of that, gathering all the support for the adjusting entries, all the documentation. That stuff is done by the controller. And then the CFO does stuff like forecasting financial performance for the future, deciding if they need to raise money, whether they're going to do it with debt or by raising debt or by issuing stock, or how much dividends or stock buybacks they're going to do. Those would be CFO decisions. And then the controller focuses on the operations of the accounting, figuring out what happened during the period, focusing on the month-end close. And generally, we have a checklist such as this, right? There's, you know, it's all done in a checklist. And generally, there's a day on every month in the month end close, and everybody has certain tasks on a certain day, and they have to get done. And then by day 10 or day 14 or whatever, they have the trial balance. And then on day 15, they have a draft financial statements, and then they can get that to um, preparing the financials, right, for releasing. If it's a big public company, there's big deadlines, right, for releasing quarterly and um, annual reports and earnings. And even if it's just month to month and there's no like government mandated or investor mandated deadline for reporting this stuff, it's still important for like the management internally of the business. It's like, okay, what were our numbers last month, right? They have to have their meetings and know to make decisions going on in the future. It's like, okay, well, how are our sales this month? How is everything going? Where do we need to redirect this attention and funds? And so then we have the steps in the accounting cycle. Uh, right. So these are all the steps we just went over. And so we start with analyzing the transactions in the journal, then post it to the ledger, prepare unadjusted trial balance, gather the adjustment data, prepare the spreadsheet. Then we make the adjusting journal entries and adjusted trial balance. Then a financial statements are prepared, closing entries, and a post-closing trial balance. And so this is the order that everything is done in. And this is absolutely a valid quiz question. So you can take a picture of it if you would like. Because there just could be a question where it just says, make sure to order these properly. Um, so this is the process. And so with that, we'll go into an example. And so in this example, we have Kelly. She's operated a part-time consulting business from her home. Everybody's got to have a side gig, right? So she's got her consulting business, and she's decided that this is taken off. She's going to go full time. She's going to move to a rented quarter. She's going to operate the business on a full-time basis. And as we go through the journal entries here, these are the journal entries that she's doing. It doesn't say this in the question, but there are some things that we can assume from this. So she is contributing cash, accounts receivable, supplies, office equipment to the business, and then that all increases her capital balance. What this really means too is that she's decided before she's just sort of operating a consulting business. She's not really keeping books and records. She's not really doing any accounting for it at all. And like that's possible. When I was in school, I did DoorDash all the time, right? Like I drove for DoorDash, I drove for Instacart, I did all this stuff. That's that is I was a 1099 contractor. That was my own sole proprietorship business, right? I had nothing registered, like I wasn't registered with the government as an LLC or anything. I wasn't I did not have QuickBooks for my DoorDash business. I wasn't recording anything. And it didn't really matter. I'm just doing DoorDash, right? But that is, even if it's not registered with the government, that was legally a business enterprise. That's legally a sole proprietorship that I was doing, is how it's classified. And um, so that's likely what Kelly was doing for her consulting business, right? It's a business, even if she's not actually doing any journal entries or things like that. Um, but she's now decided to make it like an official business. And so I think what a lot of times this can entail is creating some sort of business registering thing, like for an LLC, which the big benefit of that is reducing your personal liability if something goes wrong, especially like if she's a consultant. So let's say she gives bad advice and somebody sues her. Well, previously, she's just doing this on the side. People are paying her. She's giving them the consulting services. She could be personally liable, right? There's no business protection there. A limited liability corporation means that um, they wouldn't be suing her, they'd be suing the business. And the business is the one that's providing those services. But for a limited liability corporation or or other corporation also have limited liability items, or there could be limited liability partnerships. That's really common in CPA firms, is for them to be a LLP or a limited liability partnership. That liability protection has conditions, right? Because that gives a separation. The business then is a separate entity than the person, but then that separation has to be maintained. And if that separation isn't maintained, it's called piercing the corporate veil. And then that allows the business owner themselves to be sued or personally liable for the debts or actions of the business. And there are a few ways where that can happen, and that's if there's fraud that can pierce the corporate veil, they could be personally liable for that. If the business was like severely underfunded in a way where basically and that's fairly esoteric example, but basically if a business was funded, they take out a loan as a part of the business, and then they just take all the cash out of the business, and then the business declares bankruptcy, like that would be borderline fraud, but also it would pierce the corporate veil anyway because they took all the capital out of the business sort of dishonestly, whether or not it was. So that, and then the main way though that it gets pierced is bad books and records and intermingling of finances between the business and the individual. So if Kelly starts this business account, right, and she has it as an LLC and everything's great, but she's paying for a whole bunch of business stuff on her personal credit cards, and she's paying for a whole bunch of personal stuff on her business credit cards, and the books and records are horrible and nothing is separate, then that could also pierce the corporate veil. And so, but Kelly, right, we can assume that she's doing this legit, right? She's gonna make now she's gonna make it an official business, and she's gonna contribute all the stuff. And so to do that, so then she has to contribute all the starting stuff to this new business entity. And so that's $13,100 in cash, but she's also contributing the $3,000 in accounts receivable to the business. So she was owed $3,000 by customers, and she's transferring that accounts receivable to the business. So now when her customers pay her, they'll write the check to the business and not to her, right? So that's transferring of that asset to the business. And then the supplies and the office equipment are also transferred to the business. So she's moving to rented quarters and she's transferring this office equipment to the business. You can imagine, I don't know what costs $12,500 to the business, but she's moving that. I mean, you could imagine this is she's just rented a new place. She's just moving her couch and her desk and her office chair from her house to this rented quarters, but that's a contribution of capital to the business. That's now an asset of the business. So that goes into her capital account. And she wants to boost up that capital account because that's now her basis in the business, um, which can be helpful for like if she ever sells the business for tax purposes, right? Those are now business assets. And so she can depreciate those assets because they're in her business office. They're legitimate and necessary business assets. Um, so it can depreciate those. They're now a part of the basis if she ever sold the business. Um, anyways, that's sort of a separate rant to the accounting equation, but I think it's really important to sort of get the context of like what this problem is all about, because I think it's really relevant to things that we deal with every day in just the business world and life. So what we do for this example is so step one, analyzing and recording the transactions in the journal. This is the everyday transactions, the journal entries that we've been going through the past couple chapters. So we take a look at each of the transactions, identify the accounts, identify whether it's an asset, liability, owner's equity, whether that's debit or credit account, make the necessary debits and credits for the increases or decreases of the account. Um, and then we have our chart of accounts here. Notice that it's listed in the order in which they appear on the financial statements, and which also happens to be the order of liquidity. And all of the assets start with a 1, liabilities with a 2, owner's equity with a 3, revenues with a 4, expenses with a 5. That is a very standard practice in accounting chart of accounts. And then so we have all of the transactions that we have throughout the period. For example, right, purchasing some prepaids, like those stand out, especially because like we notice that we're going to need adjusting entries later, right? So prepaid rent, prepaid insurance, um, probably going to have an office equipment depreciation entry later. But anyways, we're making all of these accounts. We have a drawing down here. And then we post all of our transactions to the ledger. We record the date in the account and then the amount of the debit or credit. Um, we put the journal page numbers so that we can trace the transactions back in an accounting software or others. It would be like a journal entry number. Every journal entry has a number, and that's so we can trace it back to there. We can know exactly what happened with this journal entry. And a lot of times that also it gets recorded who made this journal entry. So if there is a question you have about it, you can go ask them about it. And then in an in a large accounting software too, a lot of times the invoices are connected to it, and the sales order, and the purchase order, and the inventory receipt, shipping documents, and the payment documents. And so everything is all together. So it makes doing the accounting operations a lot more efficient and organized. And then we prepare an unadjusted trial balance by just adding, putting all the numbers on the trial balance in the order that is necessary. Make sure that all of our debits and credits equal. And notice how we have a zero balance for all of these different expenses down here because we're going to need an adjusting entry for those. And so then we have to assemble all of the adjustment data. For example, we had that journal entry for the prepaid insurance and the prepaid rent. So we have to get the documents that say, okay, how long was the policy for? How many months were prepaid rent? And then we can take a look at that later so we know how much to adjust for. So this is all the data that's necessary. Also, the amount of days on the payroll calendar that were unpaid at year end. Payday is a different date than the end of the month. And then we prepare an optional end of period spreadsheet. So this is the point where we prepare that because that helps us prepare the adjusting entries. That's why we prepare this before the adjusting entries. We have our unadjusted trial balance, and then we make all of our adjustments, and then we have our adjusted trial balance. And it just, um, and notice how there's a reference for each one of the adjusting entries, so that we can match them between each other. So prepaid insurance and insurance expense are matched together as transaction A. And then we journalize and post all of these adjusting entries to the general journal and then the T accounts, and which they all impact at least one income statement and one balance sheet account. And so then these are all of the transactions that we have, supplies expense, right? Supplies, the initial supplies minus um, the amount of supplies that are left, right? She contributed 1,400 in supplies when she started the business. She contributed 1,400 in supplies, and then she bought another 800 in supplies. And so then that's like a $2,400 balance on the unadjusted, and then we have to adjust that down. And then we have all of our adjusting entries. We prepare an adjusted trial balance. Fairly straightforward here. We just, adjust all of the accounts for the debits and credits that we made, the new T account balances, and then we prepare the financial statements from there. And they can be prepared directly from the adjusted trial balance or the adjusted trial balance section of the end of period spreadsheet or the individual T accounts that have the adjusted balances that were made, because it's all going to be the same balances. So we can get it from a few different sources. And in QuickBooks or in an ERP software or something, there's probably going to be a button for an adjusted trial balance report, and then that could be exported, and then you use the trial balance to create the financials. And then, so we take our income statement accounts there. We have our equity. We know we started at zero. We had $30,000 in investment by the owner, some of which was cash, some of which was her furniture and the office, the accounts payable and the supplies. So we have beginning balance, invested by the owner, net income, withdrawals, ending balance. Then we have our balance sheet accounts, and it's classified, right? We have our current assets classified as current assets, and then our office equipment. The depreciation's $330 in depreciation on that equipment, and then we have our total assets here. And liabilities is 3,420. And then owner's equity balance, that comes from the statement of owner's equity here. And then we create our closing entries. And so this 42,300 is our owner's equity capital balance, but that's not the same as the adjusted trial balance. But it will be on the post-closing trial balance because all of our revenues and expenses are the amount of the capital on the adjusted trial balance is going to be the 30,000. That was the investment by the owner. That was our initial entry where we had that initial credit to capital of $30,000. The impact of our closing entry on net is going to be the amount of net income and the amount of withdrawals. And so it really mirrors the statement of owner's equity here, and it'll adjust it to the ending balance of 42,300. And what this ends up being is an $18,300 credit and then a $6,000 debit to capital. And we're zeroing out all of our temporary accounts throughout the period. For example, miscellaneous expense, we had all these random expenses that happened during the period, 120, 130, 200, and then a $450 ending balance. And then we credited it, and now the balance is zero. And it's the same with fees earned. We had all of these different fees earned transactions throughout the period, ending balance of 23,450, a debit to revenue of 23,450, and then ending balances of zero. And we do that for all of our temporary accounts, our drawing account, our expense accounts, and then we prepare a post-closing trial balance, which is going to have it's either just going to not include at all those temporary accounts, or they're going to be zero, essentially. So, and then our capital balance is then the same amount as it appeared on the financial statements. So which of the following accounts would not be listed on the post-closing trial balance? Oh, sorry. Yes, fees earned, exactly. Um, yes, because fees earned is a revenue account, so it wouldn't be on the post-closing. So to understand why the accrual basis of accounting, so we're going to talk a little bit now about accrual basis compared to cash basis and why accrual basis is required under GAAP, generally accepted accounting principles. And in order to take a look at that, we're going to compare them and just consider like the problems that could occur if we're using cash basis. And so the accrual basis of accounting uses the revenue and expense recognition principles that we've been talking about, where revenue is accrued when it's been earned, and expenses are matched to the revenue under the matching principles so that the expenses are recorded in the same period in which the revenue was recorded the expenses are matched to the revenue that they generated. And so this requires adjusting entries at the end of the accounting period to make sure that the revenues and expenses are properly recorded and matched. And we're going to look at an example of what could happen if this was not the case. So here we have the November income statements for November for net solutions. One is accrual basis, one is cash basis. So we notice the difference is the cash basis net income is 2,900. It's just slightly less, and that's because the only difference here is supplies expense is $150 more. So what that means is they purchased $150 in supplies that were unused. And right, accrual basis, we're only recording supplies expense for the supplies that got used up. Cash basis records it all at the time the cash was paid or received. That's cash. So cash basis only just records revenues and expenses at the time that there's a cash payment. And this can create problems. So in December, this is our income statement. And so in December, under the accrual basis, we had income of 4,055, and under the cash basis, we had a net loss of $935. And the difference here is wages expense. Actually, no, wages expense is the same. No, no, insurance expense, wages expense is different. Uh, Supplies expense was different, rent expense. And that's because of prepaid expenses. And then also our revenue is substantially different as well, because under the accrual basis, this company billed a lot of revenue and they earned a lot of revenue that they just did not collect from the customers yet. And it's important to um, you know, management or employees, right, are judged on financial results. And it's important that those financial results accurately impact or accurately reflect the business reality of a company, and that the narrative that investors are looking at is an accurate narrative of the business. So we can see the problems that occur from this is under the accrual basis of accounting, net income goes slightly up, right? Or it goes up actually substantially by 33% growth month over month. And under the cash basis of accounting, it goes from net income to a net loss. So a decrease of 132% in net income. And so the story in the accrual basis could be that Net Solutions is profitable and rapidly expanding, right? They have almost a 40% profit margin and increasing revenue, increasing net income. And under cash basis, they have a huge loss, and their revenues are falling, their expenses are increasing. And so it suggests that they might not be able to continue as a viable company without operational changes. There's something clearly wrong. What the heck is going on? And so then, right, that could create a lot of pressure on management to change something when the things that are being changed, right, aren't actually relevant. They prepaid for insurance. They prepaid for supplies. That's normal, necessary activities to a business. A lot of times, insurance companies provide really big discounts for prepaying insurance 6 months in advance. Highly recommend you look into that with your car insurance, if that is applicable to your policy, because I save, I used to save a bunch because of that. They didn't offer a discount anymore. But if the business has the money to prepay for the insurance, if the business has the money to prepay for the supplies, they should be able to do that without having it being interpreted wrong, essentially. And also, it gives an accurate picture. Accrual basis gives an accurate picture of how profitable was this revenue to generate. And I think that so in the first accrual basis example, the profit margin is almost 40%, which is pretty great. And under cash basis, it's like a negative, almost like a negative 15% margins. And so at that point, it's like, well, what's the point? What are we even doing? Is this revenue even sustainable business activities to do? And so matching the expenses to the revenues that they generated is really important. Because It's important for investors to have an accurate picture of what's going on, and also management, employees, people respond to incentives. And if the incentive is to make the number look good, there could be random games played with accounting, right? Making sure that the pay, right? If they just changed the payroll date from the 31st of the month to the first of the next month under cash basis, then they just wouldn't have salaries expense for that last 2 weeks. That would be crazy, right? Like that was a legitimate business expense. So, anyways, the reason why a lot of companies use, or not a lot of companies, the only reason to use cash basis is simplicity for a small business, essentially. That is the main reason to do it because you can get a bank statement, um, and just take each transaction and put it right on the income statement, and it's good for personal reporting. If the business owner is the only one using it, they're only accountable to themselves. Accounting is meant to be useful to the business and not take up too much time and resources that could otherwise just be used elsewhere, right? It's meant to be useful. So that's why cash basis is sometimes used. Um, and so, for example, uh, PepsiCo has a variety of brands such as Frito-Lay, Pepsi, whatever. They had net income of 7.6 billion and 2.7 uh, billion of depreciation expense. If they'd use cash basis, its net income would be higher, almost 11.6 billion. Why would it be higher if they use cash basis? Well, depreciation expense is a huge part of that, and other non-cash expenses, or non-cash maybe revenues that have been generated last period and then paid in this period, right? So it's the main difference between cash basis and accrual basis is the timing of expenses. It's not whether the expenses get recorded at all. It's just a timing issue. So this like prepaid insurance, prepaid supplies, prepaid rent, that's all just being recorded in one period instead of another, or the revenues being shifted from one period to another. That's the difference between these two. But the timing is really important for showing the business reality. Anybody have any questions on accrual versus cash basis? Okay. Um, so we're going to talk a little bit about working capital and current ratio, and that relates to the liquidity of a business and the solvency of a business. So, um, working capital is current assets minus current liabilities. And just a second here. Um, and this is described as an actual number here. So actually, just for a second, I got to make sure my computer's plugged in right. It's not gonna like that. Um, so the ability, so for example, if a business has $2,000 in current assets and $1,000 in current liability, its working capital would be $1,000. And that's really important to just know. It's it determines the capital requirements of a business, right? So it's important to like think about startup costs of a business. If there's always money going out and money coming in, if they have to have $1,000 in working capital, that's $1,000 of initial investment that's really needed in the business. That's a like a working capital requirement of the business. So, and it also shows if the business has a positive working capital, that they are able to pay their current liabilities out of their current assets. And so it's really a liquidity metric. So current assets are more liquid than long-term assets. And so a positive working capital indicates that the business is able to pay its current liabilities and is solvent. So if working capital increases, um, it improves a company's short-term solvency, which is its ability to pay its short-term debts. And for example, if we have current assets of 7,045 minus current liabilities of 1,390, then we have um, working capital balance of 6,355. And the current ratio is um, current assets divided by current liabilities. And that's a ratio that determines how much as of, like it compares it uh, between current assets and current liabilities, like what's the level of liquidity and solvency that they have. And it allows you to compare between companies, right? So if of different sizes, it's really important to compare. And then that also allows us to take a look at how does it compare to an industry average. So for example, this company's liquidity ratio, or not liquidity ratio, current ratio is 5.6, which means that they have 5.6 times more current assets than current liabilities. They're very able to pay off everything due within a year just with the amount on hand. And if the current ratio is less than 1, then that means they have a negative working capital balance. And that means that their short-term or current assets are not sufficient to pay their current liabilities. And that can be okay in a business if they know that they're going to have cash flow coming in from revenues, from operations, throughout the period, so that they know that they're gonna have the money to pay it as it comes due. So that could be okay, but it all just depends on the industry average. So um, you could think of companies like a railroad or a utility or a consumer staples company. They could have negative working capital because the cash flows are so predictable. They know they're going to have revenue. They know they're going to have money coming in the next few months. Um, that's going to they're going to be able to pay their short-term liabilities when they get that revenue. There's also companies where high current ratios are extremely common. And I would say especially like um, biotech or pharmaceutical startup companies have really high current ratios and really high working capital as a percentage because they're not getting revenue, right? A pharmaceutical company, especially one that's just starting out, all they do is have money, spend it on clinical trials, report results to investors, and the investors have to keep putting money into the pharmaceutical startup until they get the drugs approved and they either sell it to one of the big pharma companies or they start producing it themselves. And then they finally have revenue like 6 years later when the drug is finally approved. So it's really industry specific on what the current ratios are for different companies. Um, and it could also be just companies like Apple, like big tech companies generally have pretty high current ratios because they just have so much cash and they're trying to figure out what to do with it. And also that huge piles of cash allow them to invest in crazy new projects like um, or buying out other businesses. For example, like when Facebook bought out Instagram, or when um, like Nvidia investing in a whole bunch of new chip design or fabs or something like that, or they don't build fabs, but investing in new technology or um, data centers. So it's very industry specific. Um, and then the end of period spreadsheet. So these spreadsheets are not really a formal part of accounting records, but they are very useful in producing the financial statements and producing the year-end accounting processes and the accounting journal entries. And if you go into accounting or if you have your own businesses in the future, you will likely have the official journal entries in the accounting system and then all of your own personal spreadsheets that you produce every month just to figure out where things need to go, right? Because um, it's just helpful, right, to organize and understand. And so what we do is we put the unadjusted trial balance with all of the uh, ending balances for the period, and then we gather all of the information for the adjusting entries. We have to label the period. For example, for the month, 2 months ended December 31st, we label this is our end of period spreadsheet. It could also be like called adjusting entries worksheet or something like that, or like financial statements worksheet. Like there's plenty of different names that we could give this if we're working in an accounting department creating this stuff. Then we have prepare all of our adjusting journal entries, and you could imagine other tabs to calculate what these journal entries need to be that could show like a support, right? So if this also helps in creating a business processes and business in like from a business management perspective, it's important to have things documented, repeatable, so that if the person preparing the books, preparing the spreadsheet leaves, we know exactly what they were doing the past couple months, and their manager can review it properly when they're reviewing and posting these journal entries. So it's just really important in that regard there. And then prepare the adjusted trial balance. Then all of that just goes straight to the income statement and the balance sheet. We can prepare it right from there. And then we can have just something on the bottom that shows how much was the net income for the period. Right. And so we can get all of the adjusting data. And then, so we have transactions A, B, C, D, E, and then we create the adjusting entries. Um, and we know then on the spreadsheet, like this is what the adjusting entries need to be for the period. And we can also create our closing entries then from that because we know what the ending balances are. So we can sort of create it, imagine formulaically what the closing entry needs to be. So now we're going to talk about the statement of cash flows um, and taking a look uh, at the cash account and using that cash account to create the statement of cash flows. And the statement of cash flows, it is a required financial statement. It's a part of the four financial statements, income statement, balance sheet, statement of owner's equity, and it's displayed with it because it's so important to know where the cash came from and how it's being used. And so in this example, we have cash received from customers. So we have three types of activities. We have operating, investing, and financing activities. And our operating activities is cash received from customers and cash received from rent, and then cash paid for expenses and to creditors of 12,515. And note that cash paid for expenses and to creditors, only interest expense if it's would be an operating activity because that is an expense of the business, but repaying the principal of a loan is a financing activity. Um, So financing activities include transactions with the owner, so owner's initial investment and then the withdrawals from the owner. It also includes issuances of long-term debt and repayments of long-term debt, and also stock buybacks, dividends, stock options. Those would also, well, stock options are non-cash, so they would not be in the statement of cash flows, but share buybacks and dividends would be. And then investing activities, we have cash paid for purchase of land, cash paid for purchase of office equipment. And if we sold our equipment, that would be um, a cash outflow from operating activities, or that would be a cash inflow, right? Purchasing equipment reduces cash, that's an outflow, but selling equipment generates cash. That'd be a cash inflow from investing. And same with buying or selling other long-term assets. And so we can take a look at the November and December cash transactions and put them into operating, investing, or financing activities as follows. And I have it in bigger text here for you all. So we just take a look at everything, all the transactions that happen with cash are going to be placed somewhere on the statement of cash flows because that's going to, it's a summary of all the activity that happened to cash. And so this is what's called the direct method because we're taking the transactions directly from the cash account and whatever has happened to cash and putting it on the statement or on the statement of cash flows. Um, so we have owner's initial investment of 25,000, received cash from customers. So the initial investment, that's going to be a financing activity. Receiving cash from customers is an operating activity. Received rent from land, that's going to be an operating activity because it's revenue and expenses that the business has made. Receiving cash from customers is operating, and that's all these three down here. And then for cash outflows, we have purchasing land, that's an investing cash activity. Paying expenses, paying accounts payable are operating activities because that accounts payable, even though that's paying back a liability, that was like a liability that generated an expense, right? So like that, like accounts payable was probably for purchasing supplies, for purchasing inventory. That's stuff that's used in the operations of the business. But if it was a long-term debt, right, issuing that long-term debt doesn't really relate to directly to creating an expense. It's not an operating activity. It's not an operating expense. They issue the debt and then they pay it back slowly. So the interest expense, let's say that the company um, you know, issues long-term debt to purchase equipment. The expense on that equipment would be depreciating the equipment. Um, but it would show, so the financing portion that would show it as an outflow or a financing inflow. So they got cash for issuing the debt, and then an outflow in investing. So they're purchasing an asset with cash. And then um, if they eventually sell the asset, then nothing would happen with depreciation expense or anything like that on the statement of cash flows because it's non-cash expense. Under the indirect method, you'll see um, depreciation expense on the statement of cash flows, but that's, again, that is at the end of this course, we're going to go over the indirect method. And then, right, all of our expenses we're paying out, we have it as operating activities. Let's see here. So with that, I just want to briefly go over the homework.